Welcome to our deep dive, everyone. Today, we're taking a close look at ETFs.
Yeah, ETFs.
You've sent us a really interesting mix of stuff to work with.
It's great.
Some textbook chapters.
Classic textbook chapters.
Exactly. Some notes that look like they're straight from a lecture and a blog post about a city-based ETF.
Which I'm really curious about.
Yeah, that one caught my eye, too.
Uh-huh.
Looks like you're trying to get a good grasp on how ETFs work, and that's exactly what we're here for.
Yeah, we're going to break it all down.
We'll cover the mechanics, the pros, the cons, and all the different flavors of ETFs out there.
It's amazing how ETFs have become such a mainstay in investing.
Right.
You've got those textbook excerpts that lay out the fundamentals, and then these informal discussions showing how ETFs are part of everyday conversations about money.
It really shows how accessible ETFs have become.
Absolutely.
I was looking through that ETFs.pdf you sent.
Yeah.
And even though it's a bit textbooky, like you said, it does a good job explaining the basics. I like to think of it like a basket of fruit.
Oh, okay. I like that.
You've got apples, oranges, grapes, all representing different kinds of securities, stocks, bonds, you name it.
Makes sense.
So buying a share of an ETF is like buying a slice of that fruit basket.
I love that analogy.
Right?
It's perfect. So ETFs are like funds that hold a bunch of these securities, but they trade on exchanges just like individual stocks do.
So you don't need to buy each fruit individually, you get a whole mix.
Exactly. And the price of an ETF is tied to its NAV, its net asset value.
Right. Remember seeing that term.
It gets calculated every day at the end of trading based on the closing prices of all those underlying securities in the basket.
So like taking inventory of your fruit basket at the end of the day.
Exactly. You check how much each fruit is worth, and that gives you the total value of the basket.
Okay, makes sense.
Good.
But then there's this whole concept of stale NAV.
Ah, yes. Stale NAV.
ETFs.pdf mentioned it.
Right. It can get a little tricky.
Can you walk us through that? What's that all about and why should we care?
Sure. So stale NAV usually comes up when an ETF is tracking a foreign market.
Okay.
So for example, let's say an ETF is tracking the FTSE 100 index over in London. Now the London market closes several hours before the U.S. market, right?
Right.
So between when London closes and the U.S. market closes, the ETF's price in the U.S. is still based on the NAV that was calculated at the London close.
So it's using old data.
Exactly. It's using information that's a few hours old, hence the term stale.
So there's a lag.
Yeah, there's a bit of a time lag.
What kind of problems can that cause?
Well, the main issue is that the ETF's price in the U.S. might not reflect the current value of its assets in London.
I see.
Like, let's say there's some big news or a big swing in the London market after it closes, but before the U.S. market closes, the ETF price in the U.S. won't capture that change until the next day.
So it's kind of like trying to hit a moving target.
Yeah, exactly. It adds another layer of complexity.
Definitely something to keep in mind.
For sure.
But let's shift gears a bit and talk about what makes ETFs so attractive to investors in the first place.
Absolutely. One of the biggest draws is diversification.
Right.
Instead of putting all your eggs in one basket by buying just one stock, ETFs let you spread your risk by owning a piece of an entire market or a whole sector.
So instead of just apples, you get the whole fruit basket.
Exactly. It's like having a balanced diet instead of just eating one type of food.
Right. You need a mix of everything to stay healthy.
That's a great way to put it.
And beyond diversification, ETFs.pdf also highlighted professional management as a big plus.
Right.
It's like having an expert chef put together your fruit basket for you, making sure you've got the right combination.
Exactly. Whether it's an actively managed ETF where a team of professionals is making decisions, or a passively managed one that's tracking an index, you're benefiting from that expertise without having to manage every little detail yourself.
So you get diversification and expert guidance all in one package.
You got it.
But what about the cost? Are ETFs easy on the wallet?
Generally, yes.
Good.
Especially the passively managed ones. They tend to have lower fees than mutual funds.
Why is that?
It's mostly because of their structure and how efficiently they operate.
Okay.
Since they're not actively buying and selling securities as often as some mutual funds, their operating expenses are usually lower.
So it's like comparing a streamlined kitchen to one that needs a big staff and constant adjustments.
Exactly. Efficiency is key.
So ETFs offer diversification, professional management, and lower costs.
That's the trifecta.
It sounds almost too good to be true. Are there any downsides we should know about?
Of course, like with any investment, there are things to consider.
Okay.
One thing is you usually need a brokerage account to buy and sell ETFs.
That makes sense.
And that means you'll probably have to pay commissions, and you might run into something called a bid-ask spread.
Bid-ask spread.
Yeah, it's basically the difference between the price you can buy an ETF at and the price you can sell it at.
Ah, so even with ETFs, there's still some transaction costs.
That's right.
What about the operating expenses we talked about earlier? Are those always low?
Well, passively managed ETFs usually boast about those low operating expenses, but actively managed ones can have higher fees because of all the research analysis and active trading strategies they use.
So it's like the difference between a casual diner and a fancy restaurant.
Perfect analogy. You're paying for a different level of service and expertise.
Right. So you have to weigh the potential benefits of active management against those higher costs.
Exactly. It's a trade-off.
And then there's that tracking error
Yeah.
that ETFs.pdf mentioned.
Oh, yeah. Tracking error.
Can you explain that one? Why does it matter?
Sure. Tracking error is basically how much an ETF's performance deviates from its benchmark.
So how closely it's following its target.
Exactly. Ideally, an ETF should mirror the performance of the index or asset class it's designed to track.
Right.
But things like trading costs, expenses, and the little details of replicating an index can cause some deviations.
So it's like trying to perfectly retrace someone's footsteps. You might get close, but there will always be slight variations.
That's a great way to put it.
So it's a measure of how accurately the ETF is staying on track.
Exactly.
Let's dig a little deeper into those management styles, now passive and active.
Good idea.
I'm curious to learn more about the differences between them.
It's a key concept that really shapes investment decisions. Passive ETFs are all about tracking a particular index or asset class.
So they're just cruising along, following the market.
You got it. They're like the cruise control of the investing world. They're aiming to match the market's performance, not beat it.
That sounds like a good option for people who want a hands-off approach.
Absolutely.
What about active ETFs? How are those different?
Active ETFs are more like driving a stick shift. You need to be more involved.
Oh, wait.
Their goal is to outperform a specific benchmark by strategically buying and selling securities.
So they're trying to beat the market.
Exactly.
Right.
They're relying on research analysis and market insights to make those strategic moves.
So it's like having a skilled driver behind the wheel, looking for shortcuts and better routes.
That's a great analogy.
So active ETFs involve more decision-making and potentially more risk and reward.
That's right.
It sounds like they might be a better fit for investors who are more comfortable with risk and want to be more hands-on with their portfolio.
Exactly. It all comes down to your individual goals, risk tolerance, and how much you want to be involved.
Makes sense. So choosing between passive and active really depends on the individual investor.
Yeah, absolutely. There's no right or wrong answer. It's all about what's best for you.
And I came across this interesting example in one of the sources, that lesson3reading.pdf.
Oh, yeah.
It talked about a city-based ETF called Nashaw.
Nice.
Yeah, it invests in companies that are based in Nashville.
Interesting.
Can you shed some light on these specialized ETFs? What are they all about?
So specialized ETFs like Nashaw represent this fascinating trend where ETFs are going beyond broad markets or sectors and focusing on really specific themes or niches.
So instead of just investing in tech or healthcare, you could invest in a specific city.
Exactly. In this case, Eshijich gives investors a way to bet on the growth of Nashville's economy by investing in companies headquartered there.
It's like investing in a slice of the local pie.
That's a great way to put it.
But this also makes me think about diversification.
Right.
We've talked about spreading your risk across different assets.
Yeah.
But wouldn't investing in a city-based ETF kind of concentrate your risk?
That's a great point. While a city-based ETF might offer some diversification within that specific region, it doesn't have the same broad diversification benefits of an ETF that tracks a wider market or a diverse sector.
Right.
So if that local economy were to take a hit, the city-based ETF would probably be affected more than a broadly diversified ETF.
So it's like having all your eggs in one basket, but the basket is made up of local businesses.
Exactly. It's a higher risk, higher reward situation.
So those specialized ETFs can be interesting, but you need to really understand the risks before diving in.
Absolutely. They require a bit more due diligence.
For sure. Now, speaking of understanding risk, I want to talk about correlation.
Correlation, a crucial concept.
Core.pdf goes into a lot of detail about it.
It's a fundamental concept in investing.
Can you break it down for us? What is correlation, and why does it matter so much when building a diversified portfolio?
Sure. In simple terms, correlation measures how closely two investments move together.
So do they move in the same direction, opposite directions, or somewhere in between?
Exactly. A positive correlation means they tend to move in the same direction. When one goes up, the other usually follows.
Okay.
And a negative correlation means they tend to move in opposite directions.
So when one goes up, the other goes down.
Exactly.
Interesting. So correlation is all about understanding how different investments interact with each other.
That's a great way to think about it. It's like a dance between different investments.
Right. And why is this concept so important for diversification?
Well, the real power of diversification comes from combining assets that have low or negative correlations. I see.
If you have assets that move in opposite directions, it can help you reduce your losses when the market gets bumpy.
So it's like having a shock absorber for your portfolio.
Exactly. When one investment stumbles, the other one helps to smooth things out.
It's like having a backup dancer for your portfolio. When one dancer trips, the other one keeps the performance going.
I love that analogy.
But I remember Volatility in Core.pdf mentioned a situation where correlations didn't really work as expected.
Oh, yeah. What was that?
It talked about January 2022 when UK bonds, Bitcoin, and the tech sector all dropped significantly within a short period.
Ah, yes. That was a good example of how correlations can shift, especially during times of high market volatility.
Right. So even if you have a diversified portfolio,
Yeah.
you can't completely eliminate risk.
Exactly. Especially when things get turbulent.
But Core.pdf also talked about different ways to measure correlation. Pearson, Spearman, and Kendall. Can you walk us through those? What do they mean and how do they matter for investors? Absolutely. Each method has its own quirks, but they all aim to quantify the relationship between two variables.
Okay.
Let's focus on the Spearman correlation since it's particularly helpful for investors.
Okay.
Unlike Pearson, which uses raw data and can be sensitive to outliers, Spearman uses ranked data.
So it's like comparing class rankings instead of raw test scores.
Exactly. It gives you a different perspective on how two investments might be related.
That's really interesting. So how can understanding these different correlation methods help investors make better decisions?
By understanding how correlation is measured, investors can get a deeper insight into the true relationship between different assets.
So it's not just about picking assets that seem different on the surface.
Right. It's about understanding the math behind their relationship.
Okay.
This knowledge can be really valuable when you're building a portfolio because it lets you assess the potential diversification benefits of different combinations of assets.
So you can make more strategic decisions based on data, not just intuition.
Exactly. By using correlation analysis, investors can build portfolios that are designed to handle market swings more effectively.
It sounds like correlation is a powerful tool for investors to have in their toolkit.
It definitely is. It's all about understanding how different investments interact with each other and using that knowledge to build a more resilient portfolio.
Well, this has been a great start to our deep dive into ETFs.
Yeah.
We've covered a lot of ground already, from the basics of what an ETF is to the complexities of correlation.
And we're just getting started.
Exactly. In the next part, we'll delve even deeper into the world of ETFs, exploring different types of ETFs and how to choose the right ones for your investment goals. So stay tuned for more ETF insights.
Can't wait. So we've been talking about correlation and how important it is for building a strong portfolio. But let's bring this back to you. How can you use this knowledge of correlation to actually make smarter investment choices?
That's the key question, right?
Yeah.
It seems like understanding correlation is all about finding those investments that can balance things out when the market gets rough. Like having a diverse team of athletes, each with their own strengths, working together towards a common goal.
Precisely. When you're building a portfolio, it's not enough to just choose investments that sound different or are in different sectors.
Right.
You need to dig deeper and really understand how those investments are going to behave in relation to each other.
Okay.
Like if you're already heavily invested in tech stocks, just adding more tech stocks, even if they're different companies, might not give you the diversification you're looking for.
Right. It's like adding more apples to your fruit basket when you already have plenty.
Yeah.
You need to branch out to bananas, maybe some more exotic fruits.
Exactly. You need that variety. And that's where correlation analysis comes in.
So you can see how those different investments have interacted in the past.
Exactly. By understanding the historical correlations between different asset classes, sectors, even individual securities, you can make smarter choices about what to include in your portfolio and how much of each.
So it's like having a roadmap that helps you navigate the market and find the best paths to reach your destination.
I like that analogy.
But navigating the market often means dealing with detours, especially when volatility pops up.
It definitely does.
Earlier, we talked about that January 2022 example where Assets that weren't supposed to be correlated suddenly started moving together.
Yeah, that was a good reminder that things can change quickly.
So how can investors prepare for those unexpected shifts in correlations?
Well, you can't predict those shifts perfectly, but you can use strategies to minimize their impact.
Okay, what kind of strategies?
One approach is to regularly review and rebalance your portfolio.
Makes sense.
Because as correlations change the way you initially divided, your assets might not be providing the diversification you need anymore.
So it's like checking your map every now and then to make sure you're still on the right track.
Exactly, and making adjustments as needed.
What other strategies can investors use to handle the complexities of correlation?
Another good one is to diversify across different asset classes.
Okay.
We usually think of stocks, bonds, and real estate as the main asset classes, but don't be afraid to explore alternative investments too.
Alternative investments? Like what?
Things like commodities, precious metals, even digital assets.
So you're saying add a little spice to the portfolio.
Exactly, but
Yeah.
just a pinch.
Right, because too much spice can be overwhelming.
Exactly. It's all about finding the right balance for your individual needs and preferences.
And how do you know which alternative investments to choose and how much to put in?
That's where your investment goals, your risk tolerance, and your time horizon all come in.
Makes sense.
If you're a long-term investor and you're comfortable with a bit more risk, you might put a small portion of your portfolio into alternative investments that have historically had low correlations with traditional assets.
So it's like adding a dash of hot sauce to your dish. It can add some kick, but it's not for everyone.
Exactly.
And we can't forget about geographic diversification either.
Right. It's not just about what you invest in, but also where you invest.
So spreading your investments across different countries and regions.
Exactly. That can give you even more diversification benefits. Remember that city-based ETF, NSH, we talked about earlier?
Yeah, the one focused on Nashville.
Right. While it offers exposure to that specific local market, it also highlights how important it is to consider geographic concentration.
So it's like deciding whether to explore different neighborhoods in a city or travel to different cities altogether. Both offer unique experiences, but they come with different levels of risk and reward.
I like that analogy. It's all about finding the right balance for your individual needs and preferences.
So we've got this deeper understanding of ETFs correlation diversification. Now, how can we put all this into practice? How can we actually use these concepts to make better investment decisions?
It all starts with defining your investment goals. What are you trying to achieve?
Right. Are you looking for long-term growth, trying to protect your capital, generate income, or maybe a combination of those things?
Exactly. Once you know your why, you can start building a portfolio that aligns with your goals.
Okay, so figure out your goals first. Then what?
As you're building your portfolio, don't forget about those expense ratios.
Right, those fees can eat into your returns over time.
Exactly. It's like those hidden fees that suddenly inflate your vacation budget. They might seem small, but they add up fast.
So pay attention to the fine print.
Absolutely. When you're comparing different ETFs, look closely at those expense ratios and consider them when making your decision.
So it's like being a smart shopper in the ETF supermarket, comparing prices, checking labels, making choices that fit your budget and your taste.
Exactly.
And while you're browsing those ETF aisles, remember tracking error.
Right. The goal of an ETF is to mimic its underlying index, but there can be some differences.
So it's like following a recipe. You might follow the steps perfectly, but your dish might still turn out slightly different.
A perfect analogy.
So when you're looking at ETFs, check their past tracking error to see how closely they've followed their benchmark. The smaller the tracking error, the more reliable that ETF is likely to be.
Makes sense.
It's like choosing a trustworthy travel guide. You want one that accurately reflects the terrain and keeps you on the right path.
Absolutely.
Now let's go back to those specialized ETFs we talked about earlier.
Okay.
That city-based ETF, Nashish, really sparked my curiosity.
Yeah, Nosh is a great example of how investors are looking for more targeted exposure to specific themes and trends.
In this case, it's about tapping into the growth of Nashville's economy.
Right.
But it also raises questions about diversification.
Definitely.
Is geographic concentration really diversified, or does it expose you to risks that are specific to that region?
That's an important point. A city-based ETF might offer some diversification within its local market, but it's definitely more concentrated than a broad market ETF. So if Nashville's economy were to struggle, Nashville investors would likely feel it more.
So it's like putting all your eggs in one basket, but the basket is made of local businesses.
Exactly. It's higher risk, but potentially higher reward.
So those specialized ETFs can be appealing, but it's crucial to approach them with caution and understand the potential downsides.
Absolutely. Do your homework before jumping in.
Before we move on, I have one last thought I want to throw out there.
Okay.
We've talked about ETFs tracking different indices and asset classes.
Right.
But what about the possibility of ETFs tracking more unconventional things? Could we see ETFs that track social impact or environmental sustainability?
That's an interesting idea, and it's not as far-fetched as it might sound.
Really?
We're already seeing this trend toward ESG investing, environmental, social, and governance factors.
Right, I've heard about that.
And it's only a matter of time before we see ETFs that cater to that demand.
Imagine an ETF that tracks companies with a strong record of social responsibility or those leading the way in renewable energy.
Exactly. It's a whole new way of investing where financial returns are linked to positive impact.
So it's not just about diversifying your portfolio, but also diversifying your impact.
That's a powerful concept, and it's something that's going to shape the future of ETFs.
It's exciting to think about the possibility.
It definitely is.
Well, this deep dive has been incredibly insightful. We've learned so much about ETFs, correlation diversification, and the future of investing.
And we still have more to explore.
Exactly. In the final part of our deep dive, we'll get into the nitty-gritty of different types of ETFs and how to pick the right ones for you. So stay tuned for even more ETF knowledge. So we've covered a ton about ETFs already, but there was something in ETFs.txt that really caught my eye. It talked about a special way that ETF shares get created and redeemed and how that helps keep costs down. Can you break that down for us?
Definitely. It's called the creation and redemption process, and it's one of the things that makes ETFs different from those traditional open-end mutual funds.
Okay.
Instead of individual investors buying and selling shares directly from the ETF provider, there's this extra layer, these authorized participants.
Authorized participants. That sounds pretty exclusive.
Mm-hmm.
Who are these players in the ETF game?
You can think of them as the VIPs of the ETF world. They're usually big institutions like market makers or institutional investors who have a special arrangement with the ETF provider.
Okay, so they get special access. What do they actually do in this whole creation and redemption process?
Their role is super important. They're the ones who can actually create new ETF shares or redeem existing ones, and they do this in big blocks.
Okay.
So let's say there's huge demand for a specific ETF.
Yeah.
This authorized participant steps in, buys up the underlying securities that make up the ETF basket, and then swaps those securities with the ETF provider for a chunk of brand new ETF shares.
So they're like the master chefs of the ETF world, taking the ingredients and whipping up fresh batches of ETF shares.
Exactly. And if things go the other way and there's a lot of selling pressure on an ETF, those authorized participants can redeem their shares for the underlying basket of securities.
It goes both ways.
Right. This whole system helps make sure the ETF price stays in line with the value of its assets, that NAV we were talking about.
So it's like a self-regulating system keeping everything balanced.
Yeah, you could say that.
But all of this happens behind the scenes, right? We as individual investors don't really see these authorized participants.
That's right. We just buy and sell ETF shares on the market like we would with any other stock. That whole creation and redemption process is going on in the background, keeping the ETF market running smoothly.
It's amazing how all these mechanisms work together to keep everything in sync.
It really is a well-oiled machine.
Let's circle back to those two main management styles. For a sex of passive and active.
Okay.
ETFs.txt pointed out that most ETFs tend to be passively managed.
Yeah, that's true.
Why is that? What makes passive management so popular for ETFs?
It comes down to cost and efficiency. Passive ETFs are designed to track an index or asset class, which means there's not as much trading going on, and lower fees for management.
So it's a simple approach that works well for investors who want broad exposure without the extra cost of active stock picking.
Exactly. It's like hopping on a train and enjoying the scenery while the tracks take you to your destination.
So does that mean active management is going extinct in the ETF world?
Not at all. There's definitely still a place for active ETFs, especially for investors who want to try to outperform the market or get exposure to more niche strategies.
Yeah.
Those active managers can use their expertise to potentially find those market inefficiencies or focus on specific sectors or themes that might be overlooked by broader indexes.
So it's like choosing a more adventurous hike, where you might go off the beaten path and encounter some obstacles.
Yeah.
But the payoff could be bigger if you navigate things well.
That's a great way to put it.
Ultimately, the choice between passive and active comes down to your own goals, how much risk you're comfortable with, and how involved you want to be.
Exactly. It's all about finding the right fit for your individual needs.
We've covered a lot of ground in this deep dive. We've talked about the building blocks of ETFs, the importance of correlation and diversification, passive versus active management.
It's been a great conversation.
What are the key things you hope our listener takes away from all of this?
Well, the biggest thing is that knowledge is power, especially when it comes to investing. The more you understand about ETFs, the better equipped you'll be to make those smart decisions about where to put your money.
It's like having a map and a compass. You can navigate the terrain with confidence, knowing you've got the tools to stay on track.
Exactly.
But even with the best tools, things can still be unpredictable, right?
Of course, the market is constantly changing, throwing new opportunities and challenges our way.
That's true.
That's why it's so important to keep learning.
It's not just about reaching a destination, it's about enjoying the journey and becoming a more knowledgeable investor along the way.
Couldn't have said it better myself.
Well, it seems like our deep dive into ETFs has just scratched the surface.
There's always more to learn.
But I think we've given our listener a great foundation to keep exploring and navigating this exciting world of ETFs.
Definitely.
Thanks for joining us on this deep dive into ETFs. We hope you've learned a lot and feel empowered to start investing.
And remember, we're always here if you have questions. Happy investing, everyone.